Scott, can you hear us at all or see? Yeah, can you hear us first of all?
Off all my stuff. So I don't know if the reverb is on my side or not.
It's off. It's off. Something's picking up.
And if I'm talking to myself, well, it'll just be like being married again. So I'm going to get started. And what I'm going to be presenting tonight is the broken wing butterfly. Don was nice enough to invite us here. I'll give you a quick disclaimer. It just says everything that we do as a firm at stratagemtrade.com is for educational purposes only. We don't ever act as an introducing broker or make any recommendations or give out any advice. We don't manage money. But please read all our disclaimers here and on our website. I'm going to go really fast tonight. Okay, very, very fast. For those who feel like they're compelled to take notes, I'll give you our email address and we'll be happy to send you the slides tonight too. So that will hopefully save you guys from having to write down a lot of notes. But I've got a lot of materials to cover in a very, very short period of time on a topic that usually requires a couple hours to teach, even from the rudimentary point of view. So I'm going to go real fast. Just a quick little introduction of who I am. I personally started on the trading floors in about 1985. I spent most of my time as a member of Chicago Board Options Exchange, but I was also on the CME and the CBOT for a while, the Board of Trade, the Mercantile Exchange, but spent most of my time on the Chicago Board Options Exchange. I left the floors in about 1996 when most of the floor traders were leaving because you could get the same thing done at home as you could while on the trading floor. And there were boutique brokers such as Thinkorswim popping up that had such great platforms that you weren't really missing anything. So why drive 2 hours each way into the city to be on the trading floors? At about the same time, I got approached by a company that was one of the first to teach options, to guest speak a couple times. And so I got hooked on teaching, and I became the head and trader instructor at Trade Secrets, Optionetics, Random Walk, etc. And I've spoken in front of as many as I think there was 3,000 people in the room, but I hate hyperbole and don't want to hear that there was 2,500 people in the room when I said 3. So I'm just going to say 2,000 people in the room at a time. I've written 16 textbooks. The first one I wrote actually was the first book ever on the broken wing butterfly, and that was my first book. And then after I'd written that, the demand for more information became so overwhelming, and I felt compelled and succumbed to the peer pressure that I just kept writing textbooks. The first book I wrote was about the BWB, and Stocks and Commodities magazine said that this and then my Collars book, etc., were the Bibles of option trading. And that kind of stroked my ego, considering I purposely chose a major in college of pre-meds, so I never had to read or write any books other than textbooks because I hate writing. And the next thing you know, I'm an author for a living. Started Stratagem a couple years ago after breaking up with my partner at Random Walk. And so we've been around for 2 years, and I do a lot of guest lecturing in Italy and at Northwestern University in the fall, etc. But as I said, I'm going to go real fast. There's a lot to cover. I'm going to sound like an auctioneer in a couple seconds. Just to let you know, you can write us at admin@stratagemtrade.com, and I'll be more than happy to send you a copy of these slides. And at the end of the class, we're going to offer everyone a free 1-month subscription to our practical option tactics class, which is held every Wednesday night at 7 p.m. for about 90 minutes. But with no further ado, let's just get started and cover what the BWB actually is. And I'm just going to go through it in a historical manner of how most people learn options. Most people, when they first start out or their birth into options trading, they usually start out by just learning what a naked option is, what a naked long put is, what a naked long call is. And then they progress and learn about spreads and go on from there. For example, let's say you're bearish on the market for whatever reason. You hear the media talking about how we're in the second longest bull market in the history of mankind, how we're at all-time highs, how we got 20 trillion in our deficit, and volatility is so low that we should have a fall. What about the trade wars, etc.? For whatever reason, let's just say you're bearish, or you just need protection on a stock. First thing most traders will do, the newbies, is to go out and look to buy a put. And they pull up the option chain, and let's say they have a diversified portfolio, or what they believe is a diversified portfolio. They're long Netflix, they're long Amazon, they're long Coke, they're long. Every time something on CNBC pops up and someone recommends it, they fall into that argument, they start buying more. So they have a basket of stocks, they want to hedge it with the SPX, or they'd rather just trade an index as opposed to individual stocks. We'll just start by using the SPX as an example. And what the SPX is just a basket of stock. It's the 500 largest stocks in the country. It's no different than the Dow, which is only 30 stocks. But we'll just use this for an example. And you can see that the SPX on this slide is at 25,1936. So obviously this was done a couple months ago. I'm recycling some slides. But let's pull up an option chain 31 days out until expiration and decide what put do you want to buy. As a new trader, picking the right put is sort of like throwing darts. And over here on the left side of the column, you see the calls, and on the right-hand side of this slide, you see the puts. And let's go through all the different strikes you have to select from. And in the SPX, there is never a shortage on strike prices. There's, I don't know, 200-300 different strikes to choose from for every expiration cycle. So what put do you buy? That's the problem. Well, obviously, as an intelligent investor, you just don't want to gamble. You want some kind of science. You want some kind of probabilities in your favor. You wanted to have the odds in your favor of picking the right put that's going to give you the most bang for the buck. So how do we go about doing it? Well, as a newbie, it's more or less no science involved. You're just sort of throwing darts at the dartboard. And let's say with the index at 25.19, you decide to go out and buy the 24.95 put. And you see it's trading for $13.70. That's a lot of money. It's $1,370 per put. When you graph it out, you look and see that this is the graph of that put. Everyone's familiar with these graphs, probably. And we see that the break even is at 24.81. So the market is at 25.19 and it's got to go to 24.81 just before we even break even. It has to get down to 24.67 before we double our money. It's only got a 29.7% chance of breaking even, only a 23% chance of doubling your money. Is this a great trade? Well, who knows? This is given that we're trading on historical low volatilities right now compared to where we normally are. Eventually, people start trading, and after a few months, most people realize that if they just go out and buy options naked, they're pretty much just flushing money down the toilet. And they think there's got to be a better way to doing this. And what do? They're exiting that baby phase, and they're going into an adolescent phase. They're starting to learn basic spreads. Instead of buying a naked option, maybe I spread off some of that risk. And that's where a lot of people actually just retard their growth. They get good at vertical spreads and they don't ever progress beyond that. But we're going to go well past that in the next 20 minutes or so. Okay, but let's say we go into the vertical spread. Which option do we sell against our long 24.95? Let's just randomly throw a dart and say we're going to sell the 24.85. We're buying at 24.95, selling the 24.85. That's a $10 wide spread. And what does the math look like? Well, if we buy the 24.95 spread for 11.30 or 13.70, excuse me, and we sell the 24.85 put at 11.80, our spread is now costing us $1.90. We've gone from $13.70 per share down to $1.90 per share. We have dramatically cut back on our cost, which means we're dramatically cutting down on our risk. And you eventually learn it's just like buying a new car and trading in your old car. That's all a vertical spread really is. You're buying the car you want and getting rid of or trading in a slightly worse off car so that you can reduce your risk and cost. So now let's say we're looking at the same long put we were looking at before, but we decide to sell the 24.85 put at 11.80 against it. What does this thing look like netted out? Well, when we take the one and offset it with the other, what does that leave us with? When we look at a break-even graph, we see the following. And again, you're going to see a lot of information coming by. I don't have a lot of time. So some of these images have a plethora of information on it, and that's why we're going to be happy to send you the slides at the end. But when these two individual positions are grouped together, what do they look like? They net out to be what you're seeing right here on this purple line. And that's the long vertical spread for $1.90 debit. And now you see that the break even of the naked option went from $24.81 to $24.93, $12 higher. A dramatically much better off break even. And then what you do is you're learning, you start to compare the naked option to the vertical spread. And what you're seeing is that you're hitting your goals a lot faster with the vertical spreads than you are the naked options under most circumstances. Now let's compare the naked option, which is in the light blue, to the vertical spread, which is in the lavender or purple color, depending on your screen settings. Notice where the break-evens on the vertical spreads are dramatically closer to at the money than the naked option. Not only that, but your risk is dramatically lower, and you actually hit your maximum profit on the vertical spread before you would even hit your break even on the naked option. In other words, when you're bearish on the market and you're expecting it to go down, you are at your maximum profit level on this vertical spread before your naked option would even get to its break-even point. And that's a big selling point for option traders. Now, as these slides progress, you're going to see a lot of animations. Don't get distracted by it. I just do it so you guys don't fall asleep. I'm not that dynamic of a speaker. I'm not Tony Robbins. So I put a lot of flash in things so that at the end of the class, when I ask for questions, I don't like turn on the sound and just hear snoring in the background. But what you're going to see on this graph right here is that under most circumstances, the vertical spread is going to beat out the naked option. Now, obviously, a huge market crash with puts or a melt up with, calls is going to be more favorable for the naked option, but those are rare instances. All we were doing with the vertical spread was we were trading one for the other. We bought the option we wanted and sold a lesser one to reduce our risk. What if we do it again? Well, that's when we enter the teenager phase. We've gone from a naked option to a vertical spread to now learning how to match up one spread versus another spread, be it risk reversals, butterflies, condors, etc. What we're entering now is the butterfly phase. We took the one option, the naked option, folded into a vertical spread. Now we're just going to fold it one more time. We started with the option we wanted, which was the 24.95 put, and we sold a lesser option, the 24.85 put, against it to create the vertical spread. Now we're going to take the vertical spread we want and sell a lesser vertical spread against it, and that becomes the butterfly. And I see that Don was cheating on me and had somebody beforehand speaking about butterflies too. So I don't have to go into a lot of detail about what a vertical spread is. You guys have already been prepped right before I hopped on. Recall that with the vertical spread, we were paying $1.90 for it. If we were wrong and the vertical spread went out worthless, we lost $1.90, which we hate to do. It's always painful when we have a loss, but it is dramatically less painful than had we just bought that naked put for $13.70 and watched that expire worthless. But can we lower our risk even more? Can we get it down below $1.90? Enter the butterfly. We originally bought one spread. Now we're going to sell another spread against it where the two spreads share a common center strike. The original spread we bought was the 24.95.85 for $1.90. Now we're going to have to sell the 85.75 put spread. And we see that the 85 puts are $11.80, the 75 puts are $10.30. That'll bring in $1.50. So we have $1.90 debit and $1.50 credit. What does that mean for us? Now the cost has gone down to 40 cents. Notice we went from $13.70 down to $1.90. Now we're down to 40 cents. And now you have the butterfly. Graphed out, this is how it looks. The lavender or purple graph was our long put spread. Now this blue, light blue, baby blue line that's being created is the short vertical spread. How do these two positions net out? You'll see this pink line come up is the netting out of the long and the short, and you have a graph of the butterfly. Now we're risking 40 cents to make 960. On 10 contracts, what does that look like? Well, our naked put was risking $13,700. Long vertical spread was risking $1,190. On our butterfly, we're now risking $400, dramatically less risk. Again, the whole process is just lowering risk. What floor traders do, what my job on the trading floor was every single day, was to lower the amount of risk I had on and increase profit potential. That's simple. Now, of these, which one do you like the best? And obviously, you know, if you say we're carpenters, you may be using a hammer most of the day, but you still have your saw and your other tools available when needed. So we're not going to get rid of the naked long put ever. We're never going to get long or rid of the long put vertical, but you may decide I like the long put butterfly. That's the main tool. That's the hammer I'm going to use most days. And that's fine. Well, we're going to take it one step further. Now we're going to go to college grad or post grad. And we're going to talk about the broken wing butterfly. We went from a naked long put to a put spread to a butterfly that took us from 13,700 to 1,900 down to 1,400. But even that 400 is too much risk. Anyone in here trade butterflies? If you've ever traded a butterfly, you realize how hard it is to make money on them sometimes. Yes, they have less risk. If you have a certain broker or certain brokers will let you have margin on them where all you have to put up for margin is the cost of the butterfly. They're great tools on a margin basis. But it's hard sometimes making money on these butterflies because they only make money in a certain tight range. And to nail that range gets difficult. So even though we've gone from $13.70 to $1.90 down to 40 cents, if that 40 cents goes out worthless, it's still painful. Okay, how do we reduce this risk even more? First of all, you have to remember before we go any further, for anybody who is not familiar with butterflies, that there are certain rules with the butterflies, and that is they're worth the most when they're at the center strike and at expiration. You'll see from these two graphs on the left, that purple curved line shows what this butterfly position looks like with 1 day to go until expiration. And on the right hand side shows what it's worth with 31 days to go to expiration. So this is basically showing you the two rules. The butterflies are worth the most when at the center strike. You can see on the left that the apex of this curve is at the center strike. And as we get closer and closer to expiration, the butterfly becomes worth more. Then we have a tight range. On the butterfly we're looking at right now, we were looking at the 24.95, 24.85, 24.75 put butterfly in the SPX with 30 days to go to expiration. At the time that we were looking at this particular butterfly, this is what the risk curve, or excuse me, the probability curve of the XPX look like? So you can see it's left of the mean, left of where the current market price is, and it kind of eyeballs somewhere around the 1 SD band to the downside where we make money on our butterfly, but it's in that tight range. So obviously there's a huge amount of other prices this market can close at that would fall outside of the strikes of the butterfly. So if it closes outside that range, we're going to lose our 40 cents, and we got to figure out, is there something I can do to get that 40 cents back? And the answer is the BWB. Now, what is a broken wing butterfly? That's what some of you guys are probably asking. And we're going to go and cover a real rudimentary definition of what the BWB is. It's just a butterfly with the out of the money wing pulled out. Or you can look at it as a regular butterfly with an extra vertical spread sail. Remember, when we're buying a butterfly, a traditional butterfly, we're buying one put spread and selling another. A BWB is buying a put spread, selling another put spread against it, and then selling one more put spread. What does that really mean? The best way to learn it is through an example. Here is the butterfly we were looking at. Okay, we were looking at the original put spread, the 24.95.85 put spread for $1.90, and then we could sell the 24.85.75 put spread against it to bring in $1.50, thus getting our net cost down to 40 cents. How do we take this butterfly, this traditional butterfly, and turn it into a BWB, or a broken wing butterfly? All we are doing is we move the tail down, 1 strike, 2 strikes, whatever, but we'll just say 1 strike right now. So watch that top blue dart. Well, all we're going to do is move it 1 strike further out of the money. Okay, that's all we're doing. Instead of selling or buying the 1 tail put, the 24.75 put for $10.30, we're going 1 strike further out and buying the 24.70 put for $9.60. And what does that do to the math? Well, obviously the difference between $10.30 and $9.60 is a big savings. Okay, we have a 70-cent savings. Now what the math looks like is we're going to be selling the 24.85, 24.70 put spread, and we bring in $2.20. So if you look at the top vertical that we're buying, the 24.95, and we pay $1.90 out, and now we're bringing in $2.20, we're actually getting a 30-cent credit. We're buying a $10 spread, the 24.95.85, and we're going to sell a $15 spread against it, which is the 24.85, 24.70. And now instead of paying 40 cents out, we're taking 30 cents in. Now you can have a lot of spreads expire worthless and it not kill you. What this does, though, is it often creates fear with people. They're thinking, oh my God, I bought a $10 spread and I sold a $15 spread against it. So I can make 10 but lose 15. I can lose $5. Well, if you set these things up correctly, you should be fine. For example, I can hear whoever's testing, I can hear.
Great, Scott.
We're enjoying your talk a lot.
Oh, okay,
We're
thanks.
just trying to finally fix the sound here so that we can have two-way communication. That's all. Keep
Oh,
going, please. We can't go too much longer, but we can go maybe another 5 minutes or so.
I've got 5 minutes left. You told me 30 minutes, and I'm going to go 33 minutes
Oh, absolutely.
because I don't listen. I'm always pushing the rules. No, I was going as fast as I could to get.
No, take another. Absolutely.
You know, I mean, tonight's topic is the evolution of the BWB and how it came about, how to trade them, how to find the best one. Those are all different subjects that all take, you know, another half hour each. But where I was at was this cognitive emotive dissonance that goes on with people when they first look at a BWB. They're happy that they've reduced their risk from a 40-cent debit to a 30-cent credit. Everybody likes credits. People hate debits. Okay, when paychecks come in, they're happy. When it's time to write the bills at the end of the month, it's the worst day of their life. And you got to do the same thing every single month. Trading's no different. When you get a credit to put on a trade, you're always in a better mood than when you're paying out a debit. But it does cause that concern. What if I'm buying this $10 spread and selling out a $15 spread? I've got $5 of risk. Am I going to get killed? Well, obviously, theoretically, you can lose $5 if the worst happens. But if you set the BWB up correctly, it shouldn't be a problem. And here's an example. These are just option prices I took the same day of the other butterfly, but fast forward it to right before expiration. And you can see that if we buy the 2500, 2490, 2475 put BWB, where I'm buying one, selling two, buying one, that's $10 by $15 wide. What happens? Let's say the market falls 30 SPX points. Okay. Yesterday, when at the lows, after the surprise $200 billion tariffs came, we were down 30 at the lows. In the middle of the night, we were only down about 20 during the day, but 30 in the middle of the night. Last week, when we had the original implementation of the tariffs that scared people to death, we were down 500 points, but we closed down 300 points, which is about 30 SPX points. 30 SPX points is a pretty big move. What happens to this position if we move down, say, 6 strikes or 30 points? What happens is all you got to do is move the strikes higher. And you see that our spread goes from a nickel debit to a $4.45 debit. Now, you're going to be thinking at first, it's going to a $4.45 debit. I'm losing money. No. It's a $4.45 debit to buy it. If you already had the spread on, you're no longer buying it. You're going to be looking to sell it. So now you will collect $4.45 to sell it and close it. So what cost you a nickel to get in, you can now get out at a $4.45 credit. You see that as you continue moving down more and more and more, like another 6, 7 strikes, or basically a crash, 600 points, that it does reverse. We do start eventually losing money, but we're out. We know the great thing about the BWB is you know ahead of time where you're going to make your maximum profit, and you get out before you get, right before you get to that number, right before it goes from a 445 profit to a 270 profit to a 25-cent loss, then a $2.80 loss, etc. So the important thing on the BWB that we didn't have time to cover was the criteria. How far from expiration do you go to put these on? How wide is the separation of strikes? When do I get in? When do I get out? How do I adjust if needed? What strikes do I pick, etc.? But it's an unbelievably great trade. I can honestly tell you that when I was on the trading floors, we only had one expiration a month back then, the third Friday. And as that third Friday approached, I was doing hundreds of these at a time, literally hundreds at a time, 100 by 200 by 100. And every expiration, I loved them all. I just looked at expiration like all I need is a fat man and a tree and I have Christmas. Because I'm putting on butterflies for nothing. They either go out worthless or I unwind them as they start making profits. So there's some remedial rules here attached to you for you guys. But before we go into that, I just want to know if anybody's got any questions so far about this.
Yeah, let's ask for questions. Scott, let me see if I'm doing this right. Can you hear me first of all, Scott?
Oh, I can hear you fine.
Oh, super.
Yeah.
Let's get one or two questions for Scott. And I can repeat them, I think, is the easiest thing.
And whatever works for you.
Okay. Okay, the question is, would you go at the money or how far out of the money? Is that right? How far out of the money would you suggest entering these?
That is an unbelievably great question. Okay, and that took me years to figure out. Some of it, there's a lot of variables associated with it, so I can't give a blanket answer. First of all, are we talking about an index like the SPX, or are we talking about a stock like Netflix or Google that you can also do these in? We're also talking about how much time there is to expiration. What are the volatility levels? The best way to set up a broken wing butterfly is to get the maximum separation between the strikes and in a place that when you go and look at that butterfly throughout the option chain as the market moves and you simulate for what if the market goes down 2 strikes, what if the market goes down 3 strikes.
Okay.
You can find the best butterfly that's going to give you the least cost or the greatest credit and the most protection. But it really depends on that chain on that particular day. The answer it really comes down to is when you look at the option chain, what strike is the best one to buy is given to you every single day, and it varies. It's given to you by looking at the option chain and looking at all the possible BWB combinations, and the best one is given to you by where things are trading at, not by it's always 3 strikes out of the money, or you always want to be 2% out of the money. It's given to you in the pricing based on the option chain at that moment.
Very good. Somebody said one of our people here just tried to send you an email and he said it bounced when it was sent to admin@stratagem.com. I don't know if he misspelled it, but I think
everybody misspells it. It's Stratagem is everybody puts an E in there instead of an A. Okay, like strategy instead of stratagem. Okay.
Stratagem.
Right, stratagem.
Stratagem.
Everybody misspells stratagem. If you look in the here, I'll show you this.
A stratagem trade. Did you get that right? Okay, he's got it now. Okay, another question.
Yeah,
Subsequent
everybody,
question.
that second A, everybody puts an E there as if it's strategy. But if you look up stratagem in the dictionary or in the art of war,
Well, let me ask
it's,
you a question then, Scott,
yes, sir.
briefly. Um, what do you think of all of the layerings that we have, M3 and 60, 40, 20, and all of these from the various educational organizations? Since you're the guy that practically invented this in the first place, do you think it's useful to have these elaborations of it?
Um, God, I hate to answer this because it's going to sound so jaded, but basically how I view it as all the different permutations that evolved from this thing work under certain circumstances. Um, if volatility is extremely high, like the VIX goes to a 50, then I wouldn't mind going a month out in time because you're essentially selling volatility in a safe manner. But if you're looking to do this as a bread and butter daily, strategy that you're going to implement often to make money, there's there's no point to it. The point of the strategy is to take advantage of theta. As we approach expiration, the normal distribution curve of probabilities condenses, and that's what makes this trade beautifully. As time approaches expiration, the trade becomes better and better. So do you want to go 6 months out in time where the daily time decay is nothing, or do you want to be closer to expiration when you're getting the most amount of time decay or contraction in the normal distribution curve? I understand that everybody's taken the strategy and added their own little variation to it. Some of these schools that are doing it are just doing it so I think I won't sue them for copyright violation or just to get their own little marketing bent to it. And it sounds almost cynical from my perspective, but I don't mean it that way. Okay. I think really everybody's stealing my information is almost, they say that that's the most sincere form of flattery. But I just want people to be successful. I don't care where they learn it from. So if they learned it somewhere else and they learned it right, that's great. But I saw one guy that actually works at the firm I started, and then I left because my partner and I had a difference in opinion about how to run the company. So I started Stratagem. But even he, at the company my previous company, decided to take this strategy and bastardize it, for lack of a better word, and said, first you buy the put spread, and then after the market sells off, you sell another put spread against it, and you got a bionic butterfly. And it's like, bionic butterfly, come on, this is a marketing gimmick. First of all, if I bought a put spread and the market sold off, and then I saw another put spread against it, and it's contingent on me being right that the market's going to sell off, that's a big ask. Okay? I'm putting this trade on because I don't know which way the market's going, and I want a strategy that's safe in case I'm bearish, but I'm wrong. If I put on a BWB for free or a 10-cent credit, thinking that the market is going to go lower and it goes higher, and I don't lose anything, that's great. But to put on a put spread and gamble that we're going to go down so I can get on this.
Yeah, I understand. No,
Yeah,
I understand.
it's like, it's a good strategy. I'm not suing anybody that does the trading, calls it BWB. I'm stupid, actually. I should have given away the strategy for free and just trademark the name BWB, because now I thought it was kind of a hokey name, but it's become like an industry standard. I would have made, like I would have made more money on just trademarking broken wing butterfly. Every time someone says BWB, I make a penny. I'd be rich.
Well, we want to try and help you reclaim your proper recognition. We had one last question here from Mark, or maybe the last. Let's put it that way, and that's how long close to expiration would you hold? Would you hold?
Let me make sure I'm answering the correct question. How long up into expiration do I hold it? I mean, is the question, do I hold this for 1 hour before expiration, the day before expiration, or the moment of expiration?
Where would you start? How far before expiration would you begin the trade?
Okay. That typically, when I first started teaching this strategy, it was at a different time in history. Okay, we didn't have 3 expirations a week like we do now in the SPX or OEX. We had 1 expiration a month. And so I would start these things expiration week on Monday and get as many on as I could. And as we got closer and closer to expiration, my volume would increase because my risk would decrease. Now, it's a tough balance. I would say, because the further you go out in time, the wider separation you can get. And under normal circumstances, for example, in the SPX, with 2 days to go to expiration, let me see if I can pull up my thinkers.
Yeah, we're going to have to watch the time.
Okay.
Only because the library is throwing us out.
Oh, okay. I'll speed it up then. I was going to pull up Thinkorswim and show you an example. But typically, right now, I can buy a $10 by $15 BWB in SPX for free with 2 days to go to expiration. If I want to go a week out in time, I can make it a $15 by $20 for free. In other words, the more time until expiration, the wider I can get my butterfly, which at expiration is helpful, but I do have a little bit of market crash risk leading up to it. So right now in our pot classes that I teach every Wednesday, I do live examples every single day, and we typically do them about 2 days out in time, 3 days out in time. Which, now that we have 3 expirations a week, Monday, Wednesday, and Friday, I can continuously be doing them.
Okay.
So like today, I would be doing one for a Monday expiration.
I think we're going to have to, it was absolutely tremendous. As I mentioned to people at the beginning, Scott was one of the, he wrote the book on this trade, on the broken wing butterfly trade. In the first place, you couldn't do better than get the free offer here, a free month of his seminar, which is every Wednesday evening. Scott, can we leave it at that for now?
Absolutely. It's your rodeo, whatever you want to do, boss.
We apologize for the glitches at the beginning.
You know what? It could have just as been my fault. I'm technologically in my 50s.
Okay, we'll be in further touch, Scott. Thank you.
Okay, thank you, guys.